Let's now turn to bonds and bond markets. Bonds and loans are similar in a lot of ways. They are both ways of borrowing money. You can take out a loan or you can issue bonds in the bond market. But there are some very important differences. The most important difference is bonds are financial securities, meaning that they are tradable financial assets. As a result, they have very well defined cash flows attached to them. So when an issuer is issuing bonds and therefore borrowing money by selling those bonds, the bondholders will have this piece of paper, and nowadays more like digital contracts that have these very well defined cash flows. So the question with bonds will be not so much what the cash flows will be, not like what we did with loans, but instead, since these are tradable financial assets with well-defined, already known cash flows, the question will be, how much are these things worth? So we are going to talk about two main types of bonds in Finance 363. One is the zero coupon bonds. So these are bonds that will not make any coupon payments. These are kind of similar to the balloon loans. The timeline, the cash flow structure is similar to balloon loans. And we are going to be talking about coupon bonds, which will have these regular coupon payments as part of the interest payment later on. So let's start with zero coupon bonds. This is what the timeline of zero coupon bonds looks like. We have only a face value at the end of the term of the bond. So what happens is the issuer commits to pay a certain amount to bondholders for each bond that they hold, which is known as the face value amount. So the question is, what is this thing worth, right? When these things are first issued in primary markets, that's what the investment banks that are underwriting these offerings, and that's what the investors are trying to figure out. How much is this thing worth? Or if you're trading these in the secondary markets, right? These are bonds are trading, these are tradable financial assets. When you see this trade, you're asking yourself, is this worth buying? You also need to do a similar analysis. You need to decide how much that particular bond is worth to you, whether it's worth buying or not. To be able to price these things, remember from earlier discussions, valuation is all about finding the discounted value of future cash flows. So the question comes down to, what is the present value of this face value, right? So we are discounting a single cash flow in the future. For that, of course, we need a discount rate. So the question becomes, what discount rate should we use? The answer is, of course, depends. But remember from Chapter 2, Part 2, Time Value of Money, we had this I, right? That was the interest rate. And when we were doing discounting, we were using that same I, interest rate, and then we were calling it our discount rate to find the present value of future cash flows. So we're going to do something very similar. But instead of calling it I, interest rate, which applies to savings accounts, bank accounts and loans, in the bond world, we have a very specific terminology for that interest rate. We call it the yield, the bond's yield, or yield to maturity, YTM to be specific. So that's the discount rate we're going to use, yield to maturity. That goes to the left top of that timeline. I'm going to talk more about this in a little bit. But this, discounting the future cash flows, which is only the face value of the bond, usually a round number, like some bonds will have face values of 100, some bonds will have face values of 1,000 per bond, some may have much larger denominations, it depends. We are going to be discounting at that YTM for the term of that zero coupon bond. Equation 3.4 shows us the way to find the price of the bond, right? That's the face value of the zero coupon bond. There is no other cash flow, zero coupons, there's nothing else. Divided by 1 plus the discount rate. In this particular context, it's the yield to maturity of the bond raised to n, which is a term of the zero coupon bond. So what's going on here? What exactly is yield to maturity? So think of it this way. If you were to buy this bond at a given price, the P bond, and hold it until maturity and be paid by the issuer this face value, right? Your return, annualized return from this investment would be that yield to maturity. That's why it's called yield to maturity. That's your expected return from buying this bond at that price, holding it for the term, and then collecting the face value. So when we are trying to figure out the price, we are doing everything in reverse. Instead of thinking about what your return would be, price depends on your required return. So you decide, the investor decides, how much return do I require from an investment like this, given time value of money considerations, my other opportunities of earning money, the riskiness of this particular bond, and the uncertainty about being able to collect the face value in n years, for example. I decide what the fair compensation is. That's the yield to maturity that I require. Then I use that as my discount rate to find the fair value for that bond, which is the present value of that face value at that particular discount rate or the yield to maturity I used in that calculation. So when these things are first issued by companies, what's going to happen is there's going to be some sort of an auction where investors will bid for these bonds depending on what yield they require. And then the underwriters will figure out a market clearing yield. Okay, at this yield, there will be enough buyers to raise a certain amount of money. And then that yield, based on this calculation, will imply a price. Now, couple important things here. That price in zero coupon bonds, right, with when there's a positive expected return, if the yield to maturity is a positive number, which almost always is, then we are going to have a price that's less than the face value. This is what we mean by when we say zero coupon bonds trade at a discount to face value, right? So the issuer has to pay the face value for each bond at maturity. Investors buy it at a discount, and the difference between the price and the face value is those investors' return in dollar terms, right? And in percentage terms, their return is that yield to maturity. Number two is when bondholders buy this in the primary market directly from the underwriters who buy it from the issuer who is borrowing this money, those bondholders will pay the issuer these prices. This is how much the issuer borrows. So they are borrowing P bond for each bond from each bondholder, right? And then at the end, at the term of the bond, they have to pay back face value. Okay. And again, the difference between the two is the dollar amount of the interest that they will have to pay. All right, so this is important in primary market calculations, right? How much do I think it's worth? It's a matter of what is my required return from holding this, which is the yield to maturity. I discount at that discount rate at yield to maturity, and that gives me a fair value that I want to pay for this. In secondary markets, though, these bonds are trading a lot. So if you go and buy an already issued bond in the secondary market, you are going to observe the price. You go to your brokerage account, for example, and you're going to see, okay, this bond is trading at that price. There, what's more interesting is what is the implied yield? Then you can decide whether that yield is high enough or not high enough for you to want to buy it. So we also need to figure out a way where when we can observe the price, can we figure out a way to find the yield to maturity? And the answer is, of course, yes, because the two are linked, right? If you know the price, you can figure out the yield. If you know the yield, you can figure out the price. So equation 3.5 gives us a way to calculate the yield to maturity. And that's exactly the same way we did solve for I when we were doing part 2 time value of money. Remember, I equals FV divided by PV raised to n minus 1. It's the same thing, except we replace future value with face value. We replace PV with the price of the bond. N is the term of the zero coupon bond. It's the same formula. Instead of giving us I, the interest rate, it gives us the yield to maturity. So when you observe the price, when you observe face value and the term of the bond, this is your expected return, so yield, from buying this bond at that price, holding it for n years until maturity, and then collecting the face value. This is our expected return. So what does this look like in real life? Let's look at an actual example. Among corporations, at least in the US, zero coupon bonds are fairly rare. We see corporations issue coupon bonds, so with regular interest payments all the time, but zero coupon bonds are very rare when it comes to corporations. The US government issues zero coupon bonds a lot, and please make sure you read the text carefully. There it's explained that the type of the zero coupon bonds the US Treasury issues to borrow is called the T-bills, treasury bills, and they always have at most a maturity of 1 year. So they are short-term bonds, and they are always zero coupon bonds, those short-term bonds. There's an exception. There are a couple exceptions that I was able to find. One is AT&T had issued a zero coupon bond with 15-year maturity, and that 0%, that's what it means. 0% means it's not interest-free. It's not, but 0% next to the bond means coupon is zero. So let's take a look at that. So this will take us, I'll show you a very important website that we're going to use a lot when we are working with bonds. This is by FINRA, which is one of the regulators that we had talked about. And they compile a lot of data about stocks and companies and bonds and mutual funds. So we're going to use this a lot. And they have a lot of data about bonds. And here you can see, when we look at AT&T, at the top left, coupon rate, right, which is telling us those regular payments that they make, is zero. So this is zero coupon bond. This is maturing in November 27th, 2022. So there's a little over 2 years left until maturity. And this was issued in 2007. So this was a 15-year zero coupon bond. And at the time, they borrowed a little over $1 billion. These numbers are in thousands. So they borrowed a little over $1 billion. All right. So this is what a zero coupon bond looks like. And this is, we are seeing the change in price over time.